In early March of 2009, the financial world felt like it was collapsing in real time. The stock market had fallen for months, major banks were disappearing, and television anchors spoke in the kind of worried tone usually reserved for historic disasters. The S&P 500 had dropped to levels that many investors thought might never recover. Retirement accounts were suddenly worth far less than people had planned for, and the phrase "worst crisis since the Great Depression" appeared in headlines almost every day. Fear was everywhere. Many people stopped investing entirely, convinced that the safest move was to wait until the chaos settled down. Yet, in the middle of that uncertainty, a quiet decision by one ordinary person shows how wealth is often created during moments when confidence is at its lowest. A public school teacher named Margaret had been saving money for years, planning to eventually use it as the down payment for her first home. Instead of waiting for the market to calm down, she invested that savings into a simple S&P 500 index fund while the market was still near its bottom. To the people around her, it looked like a terrible idea. Friends warned her she could lose everything. Family members told her the crisis might get worse and that she should wait for stability. But Margaret made the decision anyway. She didn't believe she could perfectly predict what would happen next. What she did believe was that fear sometimes creates opportunities that only become obvious years later. So she invested and continued living her life. What followed over the next decades surprised almost everyone who had been watching the news back then. The market didn't just recover, it entered one of the longest bull runs in modern history. From those panic-filled lows, the S&P 500 climbed several 100% over the following years. Investors who had quietly stayed in the market saw their portfolios expand dramatically. Margaret's investment, which once looked reckless to people around her, gradually multiplied as the years passed. Her story isn't unique. In fact, it reflects a pattern that repeats throughout economic history. The largest wealth-building periods rarely feel comfortable while they are happening. They often begin during moments when most people are worried, distracted, or convinced that the future looks uncertain. After the 2008 financial crisis, millions of ordinary investors quietly accumulated wealth simply by continuing to invest while markets recovered and economies stabilized. The numbers tell a remarkable story. In the years after the crisis, the number of millionaire households in the United States rose dramatically. What had once been a relatively small group expanded into tens of millions of households with seven-figure net worth. Many of those people were not famous entrepreneurs or Wall Street insiders. They were teachers, engineers, nurses, accountants, and small business owners who steadily invested through retirement accounts and index funds. Wealth researchers often refer to them as everyday millionaires, people who built significant net worth through consistent saving and long-term market participation rather than sudden financial windfalls. What makes the present moment especially interesting is that another powerful economic shift is already underway, one that many people have heard about but rarely stop to fully consider. Economists call it the Great Wealth Transfer. Over the next 2 decades, an enormous amount of money is expected to move from older generations to younger ones through inheritance, gifts, and charitable transfers. Estimates from wealth research firms suggest that the total value of assets changing hands could approach or even exceed $80 trillion. To understand how large that number really is, it represents wealth accumulated across many decades of economic growth, including homes, businesses, retirement accounts, and investment portfolios. Much of this wealth currently belongs to the baby boomer generation, people born in the decades following World War II. As they grow older, those assets will gradually move to their children, grandchildren, and institutions. Some families will receive significant inheritances, while others may receive relatively modest amounts or none at all. But the deeper impact of this transfer goes far beyond inheritance itself. When trillions of dollars begin moving through the economy, that capital does not remain idle. It gets invested in new ideas, spent in local economies, and redeployed into markets and businesses. Every movement of capital creates ripple effects. Investment accounts expand, companies gain funding, housing markets shift, and new industries receive resources to grow. Even people who never inherit large sums can benefit indirectly when capital flows through the broader economy. History shows that large movements of money often reshape economic opportunity. After World War II, government programs helped millions of returning soldiers buy homes and pursue education, triggering decades of middle-class expansion. In the late 19th century, the rise of retirement accounts and widespread stock market participation helped millions of families accumulate wealth through long-term investing. Each of those periods produced new groups of millionaires who simply participated in expanding economic systems. The coming wealth transfer may represent another chapter in that pattern. Younger generations often invest differently than the generations that came before them. Surveys suggest they show stronger interest in innovation-driven sectors such as technology, biotechnology, digital infrastructure, renewable energy, and entrepreneurial ventures. As wealth moves into their hands, capital may increasingly flow towards industries shaping the future economy. Real estate patterns may also evolve. Some regions could see more properties entering the market as older homeowners pass down assets, while other cities may experience stronger demand as younger buyers look for places to live and build careers. Over time, these shifts influence where economic growth concentrates and where long-term opportunities appear. Despite all these complex forces, the basic strategy that has built wealth for millions of households remains surprisingly simple. Consistent long-term investing continues to be one of the most reliable ways to participate in economic growth. Historically, the stock market has delivered average annual returns close to 10% over long periods. Someone who invests steadily month after month and remains patient for decades often benefits from the powerful effect of compounding. The mathematics are straightforward, but the emotional discipline can be difficult. Every long investing journey includes periods of fear and uncertainty. Recessions arrive unexpectedly, markets fall sharply, and headlines predict that the future will be different this time. Yet again and again, economies adapt, companies innovate, and growth eventually resumes. Research has shown that missing only a small number of the market's best days can dramatically reduce long-term returns because the strongest rebounds often occur when pessimism is at its highest. The same pattern will likely appear during the decades of the wealth transfer. There will be corrections, crises, and unpredictable events along the way. But beneath those short-term disruptions, a powerful structural force will remain in motion, trillions of dollars gradually being reinvested into the global economy. For individuals planning their financial future, the lesson is less about predicting exact outcomes and more about positioning themselves to participate in long-term growth. Contributing regularly to retirement accounts, maintaining diversified investments, and developing financial knowledge can place people in a stronger position as economic conditions evolve. Over long horizons, even a relatively modest monthly investments can accumulate into significant wealth. A person who invests consistently for 30 years may find that time and compounding accomplish far more than short-term speculation ever could. Looking back through history, several periods stand out as moments when economic forces quietly created wealth for large numbers of people. Industrial expansion in the 19th century generated fortunes for early business builders. The decades following World War II expanded home ownership and retirement savings for millions of families. The technology boom and long market expansion of the late 1990s and early 21st centuries produced another wave of financial growth. The generational wealth transfer unfolding today may become the next milestone in that timeline. The interesting thing is that none of this information is hidden. Economists discuss it openly, research firms publish detailed reports about it, and financial analysts frequently mention it when talking about long-term trends. Yet, just like previous opportunities, many people overlook the broader picture while focusing on short term news. Decades from now, some individuals will look back and realize they gradually built wealth simply by staying invested while enormous amounts of capital moved through the economy. Others may wonder why they never took advantage of a shift that was happening in plain sight. Moments that shape financial futures rarely announce themselves clearly while they are unfolding. They often look ordinary at first, even uncertain. But for people who recognize long term trends and act patiently, those moments can become turning points that change the course of their financial lives.